Okay, so now let's talk about deferred revenues. Deferred basically means cash is received or paid right now or in advance, and the services and products will be delivered in a later period. And if you have already received the cash, it is your liability because you have to pay it back with your service or product in the future. And we have these unearned revenues or deferred revenues, although it has the word revenue, but we should not record it as part of the income statement. Instead, we should record unearned revenue as part of a balance sheet. So here is example. The company have its client paid a 60-day fee in advance, all right? And this period for the service is from December the 27th to February the 24th, about 60 days. And then the company earns a payment as the time passes. So basically, although the company got paid upfront for all the 60-day service, the thing is the revenue needs to be earned. And when each 5 day has passes, then there should be a recognition of a revenue for $250. So how do I get $250? That's 5 days in the ratio of 60 days in total multiplied by 3,000. So if 3,000 is the payment for 60-day service, the 250 is a payment for 5 days of services. And then you adjust the entry, all right, to reduce the liabilities and the under consulting. So for each day, $250 revenue is earned, and that basically reduced your liabilities by 250. And where that liability is, it is the unearned revenue. All right. So what you see here is after each 5 day, I'm sorry, so on December the 26th, just before the service start, your company received a cash for $3,000, and that's an assets increase, so that's a debit. And on the other side, there's an unearned consulting revenue, which is a liability, and when liability increase, that is a credit. Right? So after 5 days has passed, your unearned revenue, that liability got reduced because instead of working for 60 days, you only need to work for 55 days, 5 days short. All right, so you do not have that much of a liability anymore. And that unearned revenue as a liability got reduced by $250. And for your consulting revenue, it actually increased by 250. That's how much you earn for the consulting revenue. And your ending balance for unearned consulting revenue on the left-hand side is 3,000 minus 250. That's a 2,750. And for your revenue and income statement, well, let's say this 5,800 is somewhere is some number we have put it before. This is some revenue we earned before. It has nothing to do with this transaction, with this activity. It's just our starting balance for consulting revenue. And since you add $250 to there, so your total revenue has changed to 6050. All right, and now let's talk about adjusting entry for unearned revenue. So basically, if you are working hard and for 5 days of hard work, you earned the revenue. So the consulting revenue right here, there is a credit. And for the unearned consulting revenue, for the liability, there's also a deduction. That's a debit. So this is a part of equity. Revenue belongs to equity, and the unearned consulting revenue belongs to liabilities. So right here, the equity increase as revenue increase, and right here, liability decrease. All right. So once again, we follow the same 3 steps. We try to do the adjustment, and we look at current account balance, and also we look at the proposed or estimated current account at the end, and then we do the adjustment for the difference of the beginning at the end. And for this unearned rent revenue, okay, this is another whole example. We have unearned rent. So the company has already collected $24,000 rent in advance on September 1st, debiting cash and crediting unearned revenue. And the tenant was paying for 12-month rent. So basically, this 24,000 is the rent in total for a 12-month period. So what is the rent per month? Of course, that's going to be 24,000 divided by 12 months. That's a $2,000 rent per month. And how many months are we talking about here? From September the 1st to the year end, which is the time you need to do the adjustment. That's 4 months, okay? From September 1st to December the 31st, that's a 4-month period. And right here, you have unearned services revenue. So the company charges $100 per month to spray a house for insects, and a customer just paid $600 for 6 treatments. So each month there should be a $100 revenue being recognized, but the customer just paid 6 months of services all at once upfront. And then it should be recorded as unearned revenue, and this happens on November the 1st. From the November 1st to the year end, you have a 2 months in total. So in 2 months, there should be 2 months of work being done. So what kind of job they do? Spray chemicals in the house to kill the insects, to kill the bugs. So your customer paid a $600 cash, and that is reflected in the increase in cash and also an increase in unearned revenue. After 2 months passed, then your liability of unearned revenue got reduced. Instead of waiting for 6 months of work, you only wait for 4 months of work. So your unearned revenue got reduced by $200 from $600 to $400. So right here, we do this, what the current account equals. So for the unearned revenue, you start with $24,000, okay? And then after 3 months, actually 4 months, from September 1st to December 31st, you only have 8 months left, okay? You only have 8 months left. So you should equal to, or the leftover is $16,000, or 8 months of rent. And each month the rent is $2,000. So what is the adjustment? Just because 4 months has passed, then this unearned revenue has been reduced by 8,000. All right, this 8,000 is $2,000 per month multiplied by 4 months, which is the time difference between September 1st and December 31st. And then you record the entry in the general journal. So you will see after this 4-month period, if you want to record on December the 31st to generate year-end report, then the unearned revenue actually got a debit because this liability got reduced, and revenue actually got increased because you have earned the revenue. Okay, you earned the revenue by providing the facilities to your tenant. Okay, and for this one is unearned services revenue. Well, it's the same as unearned rent revenue. These are both deferred revenues, or should be recorded as a liability. So what happens here is that on November the 1st, the company receives cash for $600, and when assets have a debit, then this liability part have a credit. And unearned revenue of unearned anything is a credit, okay, or liability. So $600 increase there, and then at the end you only are looking at 4 months left, right? Because from November the 1st to December the 31st, there are 2 months in between, and after this 2 months you have done 2 months of work, so you only have 4 months of a job to do after December the 1st, December 31st. So that's 4 months of work, which is $400, which is $100 per month multiplied by for a month. And what is the earned revenue? The deduction here is a 200. You see from a 600 to 400, that's a deduction about 200. So basically, your unearned service revenue got a deduction, that liability got reduced. Why? Because you have already done your hard work. By providing the service for 2 months, you have already earned the credit. And this earned revenue or service revenue is a recognized revenue for this 2 months of work from November the 1st to December the 31st. And here, after we talk about the deferred or unearned revenue, now let's talk about accrued expenses. Well, accrued expenses is the expense incurred today, and then we will pay in the future. So the cost incurred in the period that are both unpaid and unrecorded. So if you have an expense incurred here, that will be a debit. And then the liability as accrued expenses, that should be recorded as a credit because you have to pay more money in the future. That's definitely your obligation. That's your debt. So right here we have an example. Fast Forward company pays its employee $70 per day or $50 for a 5-day work. The salaries are paid every 2 weeks on Friday. And basically for each 2-week check, there is $700 in total. Let's say December the 31st is a Wednesday, so 3 days of salary are owed at the year end, which equals to 70 times 3, that is $210. So basically $210 is the work for Monday, Tuesday, and Wednesday. Now you need to adjust the entry, increase the liability, and this liability is called a salary payable. Salary payable is a liability. And then you also increase the salary expense for the same amount. So what you shall see is that salary expense is being incurred as $210 because your employees have been working hard for you for 3 days and you ought to pay them $210. That's your obligation. You will pay them. You just don't pay $210 cash now, but you will pay them in the future for sure. And that will be a salary expense on the income statement to be deducted from revenues. And on the balance sheet, you have this salaries payable as a liability. That's your obligation I was talking about. So this obligation or this liability is $210. So what you shall see on the general ledger is that for salaries payables, for the liability, it increased by $210. And for the salary expenses, in addition to the previous salary, you just added another 3 days of salary. Why we say 3 days? Because we are doing the year-end financial report, and the year-end on December 31st is just 3 days after the start of the most recent pay period. Okay. Now let's talk about the future payment of accrued expenses. So now at the year end on December the 31st, the company recorded accrued salaries of 210, or that's a salary payable or salary expense on income statement. And then another, let's say 11 days have passed on, this is another 9 days have passed. So on January the 9th of the next year, the following entry will reduce the accrued liabilities, salary payable, and record the expense for 7 days work in January. So what that means is on January the 9th, so that is exactly 10 days after the Monday before December 31st. So basically it was December the 29th, which was a Monday, 30th is a Tuesday, 31st is a Wednesday, and January the 1st, that is a Thursday, January 2nd, that is a Friday. and then you have another week, you have you have your employees work for another 5 days. So in total, that's 10 days of salary. So you had salaries expenses for $210, and then you pay cash, not just to settle the bill that you owe to your workers, but also to pay the rest of the 7 days of salaries. So in total, you pay your employees 10 years of salary with 10 days of salary with the 3 days recorded as a payable, as a liability, and another 7 days recorded just as salary expenses. Okay, so once again, we follow the same steps. This time, we just do accrued expense. So we have a salaries payable when people have done work but get paid later. So at the year end, the salary expenses of $5,000 has been incurred by the company, but is not yet paid to employees. So that is $5,000 salary payable. And also the company can earn interest, have to pay interest. So on the year end, the company holds mortgage payable. Mortgage is about the loans for houses or equipment that it has incurred $1,000 in annual interest, but it's not recorded or paid yet. So we are doing something to record it, but not paying it. The company intends to pay it on January the 3rd of the next year. So let's see, for this salaries payable, your salary expense is $5,000. So what you shall see that for the salary payable, there is the increase, and that's a $5,000. At the end, you have a $5,000 salary payable. So an adjustment is $5,000, of course. And then in the journal, the salary expense is $5,000. And salary expense is from income statement, and the salary payable is on the balance sheet as a liability. Okay, and you are going to put a debit for salary expense, and you will put a $5,000 increase for salary payables. Okay, and for the interest expense, well, there is an interest expense, the interest payable at the end of December the 31st. So that basically is $1,000 from 0 to 1,000. An adjustment is just 1,000. So what happens here is there is an interest expense incurred because for the past year you have to pay mortgage. You borrow a loan from the bank, and the bank will not let you go without paying interest. So the interest expense is incurred, and you have this $1,000 debit. And then for interest payment payable, for these payables, it also increased. You just have not paid yet. It has not been settled. You will pay later, maybe 3 days or 4 days later. But right now, you have not paid it yet. So the interest is recorded as a liability to you as a interest payable. And when liability increase, that's a credit. And if we look at accrued revenues, so the accrued revenues basically are revenues earned before, but they will get paid later. Okay, and for any accrued revenues, so this would be an assets, just like a prepaid interest. All right, this will be assets. So let's say for this one, on December the 12th, the company agreed to pay $2,700 on a on January the 10th of the next year for a service over 30 days. So we're talking about 30 days of services, and in total, the person will earn the customer will pay us $2,700, and each day that's $90 work. The second step here is on December the 31st. Again, this is the time you want to finalize your financial report. So 20 days of service have been already provided. So although you have not received a paycheck of $2,700, but you have already provided your service, you have done the hard work for 20 days already. And in this accounting system, those 20 days of hard work should be recorded as accrued revenue. Since you have done the work, you just put it in your report. And then for each day, it is $90. So 2,700 divided by 30, that's $90. Multiplied by 20, that's $1,800 revenue you have earned. All right. And then you're gonna adjust the entry, so you will see unearned revenue has been increased, and you also have this account receivable being built up. So what happens here is you have already earned the revenue, which we call this consulting revenue, and that for 80 days, that's $1,800 in value. But you do not receive a cash. Instead, you will receive it in the future. So right now, you're gonna build it as accounts receivable on this general journal. Okay, and account receivable basically means the bill you need to collect later. So when do you collect it? You're gonna collect that money as the rest part of this work on January the 10th. All right, so here we have accrued services revenue. And you'll start with $1,800 revenue here. So this is assets, and when assets appear, that is a debit. And for consulting revenue, you just recognized 20 days of work, so that's $1,800 in value, and that belongs to equity. So when equity increase, that's a credit, and that's gonna build up your consulting revenue to a new level. And here is a future receipt for accrued revenues. So let's look at the case. On December the 31st, the company recorded accrued revenue earned of $1,800. This is a case we worked on before. And then on January the 10th next year, the money is being paid off. So it's not just the 20 days of work, which is at $1,800, but the rest of the 10 days in the next in this 30-day period, and the company get a $2,700 cash. So how do we record this activity? Well, first of all, this $2,700 cash is used to settle the $1,800 outstanding bill for accounts receivable. So this $1,800 is gone, and then for account receivable, it's gone. And then you have another 900 for this 10 days of work in January, from January the 1st to January the 10th, and that is consulting revenue. So basically, there are three items getting involved. You have a cash, 2,700 being received, and then that will reduce your accounts payable, accounts receivable. You have less money to collect. For this $1,800, you will not have to collect anymore because it's paid already. And then you also earn consulting revenue for another 10 days, that's 900. So that's the general journal we should have here.